Okay, cool. We finally freaking live. All right, cool. How to make YouTube less boring. All right, interesting. Mark as not interesting all the videos. Wait, what? What exactly does this do? The boring YouTube. Well, that's true, yeah. Interesting. Okay, 2020 proxy statements. Hold on, I kind of want to bring up something. Interesting. Yeah, I get it. Okay. We're going to select financial data. Let's see what this one says. OQ. Developed Narcan, conceived us, licensed to adapt, wholly owned, blah, 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 bankruptcy, we have not had a bankruptcy, blah, 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 state of incorporation, blah, 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 Narcan, sure, employee and culture, 30 employees, additional employees, 2021, commercial, everything included, blah, 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 yeah, we get it, blah, blah, blah. We have cash and equivalents of 48.3 million. Okay, here, finally, we're getting to the good stuff. Revenues, 2019 to 2020. Royalty and licensing revenue decreased by 10 million. Licensee grant contracts decreased from 40 to 29 million. So the total revenue is going to be, this should be explained in the 10K if they're a good company. Okay, less the general administrative, research, sales and marketing, and royalty expenses. Okay. Anyways, guys. Yeah, so this stream is not going to be a coaching stream for the 3 people who are watching. We're going to wait a little bit, see if we can get more people in. But basically what we're going to do today is talk a little bit about how to value tech companies. And I think this is pretty interesting considering that over the past few days or weeks, even really the past year, a bunch of tech companies have basically shat the bed when it comes to the market. And while Fang and all these other like big companies have grown. So the question really becomes, well, how do I know I want to work for this company? How do I know my stocks that I get aren't going to be complete crap in 3-4 years, right? How do I know this, like, how do I know the company is going to be around, and how do I know I'm being paid fairly? So we're going to go over all these questions. And for the most part, what I'm going to do is actually just show you how to read a 10K. So hopefully we get a few people in here before we get started. But if not, if it doesn't seem like there's enough interest, then I'll probably just shut off the stream early. But hopefully the few people who find this information interesting will stick around. So right now we're just looking at some random 10K. These are the annual reports that companies have to file with the SEC regarding like the revenues, operating expenses, and whatever. So one of the things that is actually pretty interesting, and you should keep in mind, is that when companies tell you certain numbers in, like, say, a slide deck or something, they are free to pull the truth, exaggerate, or whatever, Let me give you an example, actually. What's a good company? Someone throw out a name of a company that they want me to like value, or they think it's like shady as fuck. So go ahead, like spit it out in the chat. Actually, let's look at like something like Zoom. I think. Investors Zooms. I'm thinking maybe Zoom has one of these like annual. Yeah, actually, hold up. Let me actually pull up the Zoom 10K. Okay, so Reddit, Snap, or Shopify. Okay, let's Shopify, and Snap are gonna be good examples actually. So let's do Shopify 10K. Let's look at the Shopify 10Ks. I think this is gonna be a good one. So let's actually look at the year in review for. Wait, what's the annual file? Okay, SEC filing for 2021. 6K. Usually they'll be able to list like the 10K. The fuck? Where the fuck's the annual 10K? No, I want the SEC website. God damn it. God damn. Yeah. So basically, don't worry about the stock price. The stock price is just a popularity contest. That's the way you should treat stocks. The question is whether or not you're in a good business or not. So right now, we're just gonna start with the fundamentals. What the fuck? Did they not file a 10K? No, they should file a 10K. What the fuck is this? Fuck, annual report. Show me the goddamn 10K, man. No, I don't want the... Okay, maybe I can just use the last 10K. Shopify 2020. Okay, cool. So, if I go, like, look up for some, like, adjusted EBITDA. Okay, so do they have EBITDA? Huh. Okay, so they don't have EBITDA on their statement. Okay, that's good. I'm trying not to use Uber because, for one, I work for them, and I don't want to say anything here that would... you know, like someone finds it says, oh, well, hey, Edbert said this and shit, you know, about the company. So, I'd rather not be in that position. That's kind of why I'm being a little cagey about this. Okay, well, Shopify's Canadian, but they still have to file 10Ks with the U.S. government. So that actually doesn't matter. So they should still have the annual reports available. So if they're foreign, then they should have a 13F, I think. Annual report for an issuer, supplementary filing, no. Let's do 2020, 6K. There should be an annual here somewhere. Okay, maybe not Shopify. Let's look at Snap 10K. I'm guessing that's because of how volatile Snap is. I'm guessing that they put like some weird shit in their 10K. Just off of the top of my head, 10Q. AK, 10Q, AK, 10K. Okay, cool. Annual report. Let's take the 2021 report. So, okay. So, in theory, in general, you can actually just go to a company's website or the SEC, and you can actually pull this information up. So, if I do, like, a search for... Oh, yeah. So I'm going to tell you this. When a company slaps EBITDA all over the place, it's basically... You should read this as bullshit accounting. So... Basically, you'll see something like GAAP financial measures, right? GAAP is just generally accepted accounting principles, and these are rules that essentially govern how companies should actually report their financial information. So keep in mind that GAAP is going to try to cover all these different industries, from like retail to tech to whatever. So in general, it's going to try and it's going to try to cover all the different rules, but and all different industries, but every single industry is different, right? So there's going to be different things that they take into account, different things that they don't. So GAAP is like basically your starting point, but it's never the end all be all. And so one of the things you might notice for a lot of these tech companies, especially for the unprofitable ones or like the very volatile ones, is that you'll see this term EBITDA. So what is EBITDA? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So that sounds good, right? But why would I call that bullshit? The reason why I call it bullshit is because what business doesn't pay interest on their debt, taxes, doesn't depreciate their assets, and doesn't amortize their losses? It doesn't make sense. If you're considering the business, you want to be a holistic evaluation. You want to actually try to look at the business as soon as it's gone through all the expenses, as soon as it's gone to reinvest in itself in order to keep it going, right? If you have any experience with like doing a business or anything like that, chances are you have to not only pay your taxes, you have to depreciate your assets, you also need to reinvest for the next year. And those are called capital expenditures. So EBITDA is like kind of trying to skip all that shit. And so when you see adjusted EBITDA, that basically means, wait, we're going to do bullshit metrics on top of bullshit metrics. So what exactly is adjusted? The adjusted means it's going to try taking out the one-time expenses. Now, this is going to be kind of interesting because then when you see adjusted, you can think, it's like, it's meant to try and guide you to saying, hey, the company thinks that this shit is a one-time expense. But the thing is that if it keeps coming up, if it keeps getting adjusted, then chances are you can, in general, just consider it a recurring expense. Even though the company wants to call it adjusted, it's more or less not if you keep seeing it. And in fact, I don't even think I've seen adjusted EBITDA introduced until like maybe 10 years ago. Yeah, if you go back to like 2011, I don't think adjusted EBITDA enters the vocabulary. Anyway, so basically this is like already a pretty big red flag. But these 10Ks, like I was scrolling through it. You can see they're like 200 pages, right? But in general, most of these are just like legal disclosures that you don't actually need. The stuff that you actually want to read is like the selected financial data. So in general, when you see this, risk factors, a lot of this is just like, oh yeah, COVID's going to impact our business. Okay, thank you. We know that. So in general, if you know what the business does, you already know the risk factors. Unresolved staff comments are just like, are basically, any legal complaints, any legal stuff that they might have going on against them. So basically the part one is not really relevant to you at all unless you're very new to looking at a business. But even then, a few Google searches and reading the Wikipedia page should already cover this for you. What you really want to do is actually look at the selected financial data and then the consolidated financial statements. So let's actually look at that. So there are two kinds of... look, I'm showing you how to do it. I'm using Snap as an example. Look at Atlassian. All the steps I'm doing right now, you should be able to do on your own. I'm just giving you the high-level overview using Snap as an example. So I'll do another one maybe later, but right now I'm just trying to go over the actual mechanics of it. So what you want is basically the consolidated statement from cash flow and the consolidated balance sheet. So why did I click on that? Hold up. Let me go back and... So financial statements and supplementary data. This is what you want. So you're going to look at basic consolidated balance sheets and consolidated cash flow. That's basically the things that are really important when it comes to a business. So what exactly are these? So the balance sheet just means, hey, this is all the money and assets that I have on my books, and then the liabilities I owe as well. So that could be like debt, that could be a bunch of other shit, right? And then cash flow is just the delta year to year. So it's like all the money that's coming in and all the money that's going out. So let's look at the balance sheet first, because most of the time, you're gonna want to actually see like how much equity is in it and how much the company owes. This is like your basic. This is the first step you do when looking at things. How much? Because if you don't necessarily want to join a company that is enormously leveraged or wildly in debt, right? And so this is basically where the first thing I would look, especially if you want to try and buy it and then sell in businesses. Like if you're looking at like, value investing, one of the most basic ways of doing this is just looking purely at the book values, right? So and this is where you would do it. You would just basically take assets minus liabilities, right? So in general, this looks pretty good, right? So Snap, it has basically 2.5 billion in net book value, right? So this is the way you can look at that. But there's a few things that you might want to actually stop and look at. So first things first is like cash and cash equivalents. So the current assets just mean assets that can be converted into dollar signs and numbers within like say a year. Like let's say like some big accident comes up and Snap needs money right now. Current assets are all assets that can say, hey, all these things can be turned into money right off the bat. So this is like your most liquid form of assets when you're talking about book value. So you can see here, like basically, if you look from year to year, and I encourage you to do this with every single 10K, so that way like 2019 and 2020 isn't like a fluke. You can see like their cash and cash equivalents stay roughly about the same. The only difference is their marketable securities. So this tells me, what are marketable securities? Marketable securities are just like investments, like your stocks, bonds, and whatever that you could quickly and easily sell on the open market. So this tells me that, hey, a big chunk of their book value growth isn't coming from the fact that they are making money. A big chunk of it comes from maybe some appreciation in some stocks or some companies they made investment in. Another one is this accounts receivable. Accounts receivable just means, hey, yeah, we did the service, now we're sending you the bill and we're awaiting your payment. So accounts receivable One thing you might want to look at, especially for like some tech companies, is that if this accounts receivable stays pretty high, it just means that the company isn't like likely to collect on their debt or on what people owe them. So in other words, like this 2020 accounts receivable is a little bit high. This marketable security is a little bit high. So a lot of their money, a lot of their liquid assets basically come from, hey, well, we made investments and we're waiting on people to pay us within the year. That's basically it. And so the other thing you want to look at is property and equipment. So for tech companies, you're usually not going to see this be very high. Usually these are mostly like computer equipment, server farms, monitors, all that stuff. But for other things like maybe like Verizon that operates in telecommunications, this might be actually pretty high because, you know, they have factories, they have, well, maybe Verizon doesn't have a factory, it's got like stores, it's got like telephone lines, it's got it's got like plants and shit that they need to use to operate. So these physical assets might actually be a lot higher. Operating lease, right of use assets, that's basic property that they can use. Don't worry about it. These are in general not very high. Okay, but in general, you want to take this out. So what are these? Intangible assets and then goodwill. So what exactly are they? Intangible assets are basically just like things like your patents, your things that are not material, things that you can't directly sell but are more or less like virtual. In general, these are like intellectual property for most companies. Maybe even the value of the software that they have. Or then you have goodwill. Goodwill is just the value of the brand. So, for example, let's say I have two shoe companies, like Nike and then Chinese random fucking shoe company. Assume pound for pound, they are equal in every single respect. You know, revenue, book value, type of shoes, everything. So the question is, how much more would you pay for the Nike brand over random Chinese shoe company? That is what goodwill is. So let's say like Nike's trading at like, you know, $200 billion, right? And let's say a random shoe company is trading at 100, it would be worth like $100 billion, right? So that $100 billion difference between random generic shoe company and Nike is the value of the brand, which gets listed under goodwill. So in general, because tech companies like, you know, rise and fall so quickly, they essentially have like, basically I would say like 5 times the speed up in terms of company life cycle of a normal company. Like a company like GM can last from go from like 1900 to 2000 and then die. A tech company is only going to take 20 years to go through that cycle. You know, like think Yahoo. Compare GM to Yahoo. GM is like you know, for 100 years and then it just like it shit the bed and no one gives a fuck about it, right? Yahoo, same thing. Biggest fucking company in 2000. No one gives a fuck about it anymore. It basically went through this life cycle very fast. So in general, when it comes to goodwill, I don't really care. So I just completely eliminate this. So if there's an increase in goodwill, there is 2 things happening. 1, management is inflating the value of the brand, or 2, they've made acquisitions. So and remember what I said about acquiring companies and the difference between Nike and generic company, whatever, right? So if Snap goes out and acquires some company and then is willing to pay a premium on that, well, the GAAP accounting requires that premium be put on assets and then depreciated over some amount of time. But the thing is that goodwill is just accounting goodwill, and essentially it's like I said, these tech companies live and die. So to me, I don't give a fuck about this number. I would actually, on a conservative level, I would take this out. So what does this all mean? This basically means that out of the $1 billion that they have, was it the 2.5 net that they have? Basically, $1 billion of this is net intangibles and goodwill, and I don't think anyone can really evaluate the value of these. So I would chop that off. So immediately you think that this company has $1.5 billion of book value available to it. That's basically the way I would read a balance sheet. So, so far, are there any questions about like what I've just done? I'll cover a little bit of the liabilities, but I kind of want to make sure everyone understands what the assets are here. Because you can repeat this exercise with any company you want to buy, or any, like in general, because even in non-tech, goodwill and intangibles, goodwill is only really applicable for really strong brands that, how to say, like, don't care, like Coca-Cola. Like, in general, that brand is going to be fucking around forever, so you don't necessarily need to discount it that hard. But you should be very, very concerned when it's a significant amount of the assets. So in general, look at this like $5 billion number. $1 billion of it is goodwill. So how the fuck can Snapchat earn like what is this, like $200 million in goodwill over 1 year? How does that work? What was the story here? So immediately, those are like that's kind of a few red flags we picked out just simply looking at the assets. So if there are no more questions, I'll keep going. So current liabilities. Remember how I said before on current assets? These are all things that get converted into cash in a year. Current liabilities are all things that are owed in the year. So this means that accounts payable, means that Snap received a service, and now the other guy, some other vendor, is waiting for them to pay. So this could be like your AWS server charges or whatever. Operating leases is like, hey, I'm renting a building. And accrued expenses and other current liabilities. This is just like carryover, and you're going to need to dive a little bit more into this and to see why it's there. Again, this is like not an insignificant portion of the total liabilities, so this is something I would want to look into if I'm considering Snap. Other notes are like senior notes that are convertible. This just means that the company took on some debt and now is able to convert those bonds into stocks. So I would expect to see, based on this, that a pretty significant rise in the number of shares in Snap. So overall, from the book value, it looks more like the company borrowed a lot of money and then decided to acquire a bunch of companies. This is basically the story I think that is happening based on the balance sheet. So let's actually go to Google and see .com, and then let's look for like Snap acquisitions in 2020. So let's do this exercise, right? So I'm googling Snap acquisitions just to make sure that I know what the heck I'm doing. Make sure that this is correct, right? So we can see here that the company bought two really big companies here, right? So they acquired a Vocal AI for $70 million, and then they acquired AI Factory for $166 million. So in total, that's what, $250 million, right? So if I go back here and I look at Goodwill, that's $250 million. That's a little bit more than the Goodwill, right? So you can see here, like if I add 250 to this, I get basically $1 billion. And then minus 70 million for the software and AI tech. Fine. Whatever. But basically you notice here, like the numbers kind of add up. The numbers make sense. And all I did was look at the balance sheet. So if you can point these red flags up, and then you just try to do like a Google sheet, you do like a Google search on like, knowing that I know what these assets and these things in the book value stand for, why is this like so weird? Why is there a big jump? Is noticing these like big jumps and big discrepancies from year to year, that should tell you the story of the company. So right now, my story is that the company took on a lot of debt and acquired a bunch of companies. So to me, that's a little bit concerning, because for tech companies, in general, they want to invest in themselves. And so it's a little bit concerning, because what you'll see later on is that you don't get to write this goodwill off for like the companies that you acquire until you get like the revenue for them, and then you depreciate them over, I think, 39 and a half years. So in other words, this goodwill book value stays on the books for 40 years. But the tech companies, like I said, they don't last that long. So it's utterly fucking meaningless to put this as book value, because if I'm going to depreciate this over 39 and a half years, like I'm not going to be around to see the full depreciation. So this is a pretty big red flag for me. Like I would just, in general, if it's a significant portion of the assets, it's just gonna not be. It's just not a good thing. So far, are there any questions? Hold on, we're gonna get some water. Actually, I just realized my voice is kind of like dry. Okay, I'm back. All right. So, in other words, so let's actually look at the next part. Remember what I said before, that there are two things that are mostly important here. The balance sheet and then the cash flow. So let's look at the cash flow statement. So this is basically the delta between your year to year, right? This is the amount of money that's coming in. So in other words, let's look at, there's three ways companies can get money, right? What are the three ways? They can just do the normal operations. They can get money from investments, like, maybe they go buy stocks on the open market, and then those stocks appreciate, and then they sell them off. That's another way. And the third one is from financing, so like issuing shares, selling bonds, selling stock. Someone asks, like, what is considered good portion? Less greater than 20% for Goodwill to be considered a red flag. So you kind of get a sense of this based on brand value, actually. I would say in general, if it looks significant compared to the amount of assets that they should have, then it's a red flag. So for instance, Coca-Cola, I would not care if that was 20% because everyone in the fucking world and their mom drinks Coke, like, and that brand has been around for 100 years. Would I say it's okay for them to put like 15% of their book value in Coke Goodwill? Yeah, probably. Like, that brand's not going anywhere. But for something like Snap, like, you have to basically start looking at enough 10Ks and their comparables, and then you kind of get a sense of like, hey, yeah, this brand should be worth this much, and this brand should be worth like a little bit more than this brand. So in my mind, I'm thinking Snap is nowhere near as powerful as Coca-Cola. Now the question then becomes, what's the brand value of Coca-Cola compared to their assets, right? So let's actually do that exercise really quickly. Small side tangent. So let's look at the annual 10Ks for Coca-Cola. Because I think that every single company should try to be like the golden what's it called? The golden standard, I think, in general for any company, if they are trying to be a good brand, is Coke. Like, I don't care what anyone says. Like, this company is literally better than most software companies out there, and their cost structure is basically a software company. So let's look at the financial statements, right? For the consolidated balance sheet. So let's look at the consolidated balance sheet if I can find it. Great. So see here, cash, current assets, same thing. They have all the exact same shit. So let's look at Goodwill, right? Goodwill, Coke values its brand at $17 billion out of $90 billion, right? So that's approximately like what, 25%? Yeah, let's call it 22.5%, right? Of their assets is literally Coke. Would I value Coke as the brand itself at $17 billion? Yeah, I think I would. I would probably say, $20 billion even. Like, but that is an exercise for someone who is way better at brands than me. So in general, for Coke, so Coca-Cola has has such a reliance on the brand, right? If you told me to drink Pepsi, if you told me to drink RC Cola, you told me to drink anything else, I would tell you to fuck off. Anyone in the world would tell you to fuck off. So, is it fair for Coca-Cola to rely heavily on its goodwill and branding? Fuck yeah. Like, you see Coca-Cola slapped on the fucking Olympics. Now, let's compare it to like fucking Snapchat, right? Let's go back to the consolidated balance sheet, right? So, the Goodwill. So, they basically have essentially the same situation going. Like, almost around 20% of their assets in Goodwill. Now, is it fair for them to rely this much on their Goodwill? No! You would, like, when was the last time you saw Snap rely that heavily on their branding value to get people to join their social media, right? Everyone uses, like, Instagram, Twitter, Snapchat. They don't give a fuck. It's all homogenous. They're just trying to reach, like, TikTok. They're trying to reach everyone. So the reliance on brand value is not there. I don't believe it is. So when you paint that story in your head, like, Coke slaps their fucking label on everything. And so that's why they can probably say, hey, yeah, I'm relying a lot on my Goodwill. I'm booking it for 22%. But for Snapchat to do that, I don't fucking believe that at all. So, in other words, that means that either one, that they have acquired so many companies that they're overpaying for them, or two, they're basically overinflating their own goodwill. Neither of them is a very good sign. So, hopefully that makes some sense. Like, it's basically the story of the company that you want to tell. So, let's look at the cash flow statements. So, remember what I said before. Cash flow is literally just the year-to-year stuff. It's like what the company is going to make in 2018, 2019, 2020. All the cash in, net all the cash out. And so, let's look at this. Isn't it 18%? Okay, 18, 22%. Like, it's not that big a difference. Either way, I'm just doing these numbers off the top of my head. I don't have a calculator right next to me. But you can see, like, if they're anywhere near within that ballpark, it's probably not a good sign. So, the reason why I'm showing you, like, all these off-the-cuff techniques is because you can do them yourself. Like, if you want to be very, very specific and go use spreadsheets, that's fine. But people have been doing this long before spreadsheets. And I notice here, like, when I predicted that they made a shit ton of acquisitions in 2020, I didn't even have a calculator. I just went by the numbers. I just went by, like, approximating the numbers and doing this in my head. And it does a pretty damn good job of telling the story and figuring out what the company is all about. 18%, 19%, yeah, either way, it doesn't matter. I still wouldn't put it anywhere near Coke. In fact, I would give it, like, I'd only value the Goodwill at, like, 10% because of how many different competitors there are, and everyone is just as likely to use Instagram as they are Snapchat, as they are, Twitter. Or Facebook, I don't consider the brand value there to be anywhere near justified for the percentage of book value that they have going. So going back to cash flows, like I said, it's the amount of money that they're pulling in. So you can see here for companies that run at a loss, it's very common for them to use EBITDA to try and basically blow this all away, right? So net loss just means that it's from the operating activities. They're operating at a fucking loss. What's a competitor of Snap? Check the percentage as a comparison. Sure, you can go that far and try to come up and invent some crazy ass number. But to me, it's almost like Occam's razor, if you know what it is. It basically means that the simplest explanation is the best explanation. And to me, the simplest explanation literally just said, hey, I looked at this, I think they're acquiring a lot, and they acquired a lot. When you do something like this, it's almost always a very simple exercise of looking at very simple numbers and try to paint the simplest story. You can torture the data and get whatever number you want, which is essentially what the management does with adjusted EBITDA. But to me, I don't care. The point here we're trying to see is whether this is a good business to look at. And I'm going to show you why this is basically important later on. Because eventually what I will talk about is that the market eventually does catch up. The market eventually catches up to these fundamentals. So if you're trying to look for a company to rest invest at, or stick at it for a long time, this is going to be very important. So don't try to torture the data. There's no point. Eventually it comes back to these fundamentals and the story the company and the people who buy the company or own it really have in mind. So look at this. You see the company just operates at almost a $1 billion loss. And of course, people will tell you, oh yeah, it's going down. The net loss is going down. Let's see why. Let's see why this is going down. So depreciation and amortization. Remember what I said. This just means that the value they have assets on their books and then depreciating it year after year. So the value of the monitors can go down. The software can be depreciated over 3 to 5 years, right? So this number is pretty consistent across the board. Give or take 10%, I don't care. Stock-based compensation. It's going up every single year. So why? I am thinking either they're issuing more shares to people inside the company, or in general, the Snapchat stock has been going up. So let's actually look at Snapchat stock, right? For the past 2018, 2019, 2020, right? 2008 end of year 2018, it was at 538. So let's say around here, right? December 30. So it's rock bottom, right? And then in December 2020. November, December. Yeah. So you can see here it basically does this huge almost 10x jump. So you basically that basically explains why you have this big leap in stock price, right? So in general, this does kind of paint the story. Only they're not increasing the number of stocks necessarily. I think they're more or less just riding this trend. So this is basically stock-based compensation. I don't expect this to grow any further in the future. In fact, I expect it to basically stay around the around the 500 to 600 range. So that's something that is, that's something that we can adjust for. So next thing here, deferred income tax. That basically means, I actually don't know why they're deferring their income tax. It's just some really weird accounting thing. But it means that this will show up later on in the future. So, or they're collecting it now. So, which means that they probably deferred some taxes later on in the back, and then they're paying for it now. So when I see this, I'm going to average this across the board. So adding these numbers up and dividing by 3, I can basically say they're going to pay about basically $3,000. Let's say $3,000 worth of income tax in addition every single year. So, or I should say $3 million. So, but it's peanuts compared to this. The question would be well, this is not an essential question, but it might be worth looking into if you're an actual financial analyst. Gains on divestiture. I actually don't know what this is, so I'm going to discount it. Just because I would look it up later on, but I don't care. Amortization of debt discounts and insurance costs. So amortization of debt just basically means, hey, yeah, I'm extinguishing the debt that is being owed. So the thing is that I'm not completely convinced. I really don't like this. I would still, just because I don't fully understand what the situation is with this, I'd have to read the consolidated or specific selected financial statements in order to understand this. But this is I should see why this is happening, because notice it basically adds back in almost 10%, 8 to 10% of their net losses. So I'm like, why are we doing this? So next thing, change the accounts receivable, fine, whatever. I would still average these out because the fact is that it just changes so much. I'd use the median just to predict. So I think 2019, looking at this so far, I think 2019 is going to be actually a much more representative of the company projecting forward. So operating use of lease, accounts payable, looks pretty similar. There's a big bump, so maybe we'll pull up to 2019, 10K, and look at that. Accrued expenses and other liabilities, blah, blah, blah. Wait, where's the depreciation? Yeah, so other than these, nothing looks like out of the ordinary for me. But in general, you want to look at why, if these numbers are making a big jump or look weird, you want to, in general, look at, these numbers and just kind of ask yourself, why is that? And you might want to do a little bit more digging. And this whole entire exercise, even though I'm going slow and because I'm explaining it, it doesn't take more than like an hour. And in general, you're only going to have like 6 companies, right? So what's 6 hours of your life, or 6 offers from 6 companies, right? What's 6 hours of your life to make sure that you're working for the right one for the next 4 years? So next thing, cash flow from investing. Remember, this is all the money that the company makes by by investing, selling their assets and whatever, right? So for instance, this purchase of property and equipment. In general, you'll see this list sometimes listed as capex or capital expenditures. But in general, I think they've decided to list this as purchase of property and equipment, and merge it all into one. So this basically means that they're making their they make like, let's say $1 million, but then they only invest 3%. That they lose $1 billion, right? And they're only investing $30 million. They're only investing like 3% of the money that they've lost, and then decided to, we're gonna only invest 3% in ourselves. It's kind of weird to read numbers like this, but in general, I would have to do this against the gross operating activity. So this is not really something that I want to look at. So I'll look at I'll compare it to gross later on. But something's telling me that this is like a little bit low, especially across the tech board, where tech capex in general is almost always like Facebook's like 15%, Apple's like 15%. So why the hell is this so low? So we'll look at this later. So cash paid for acquisitions. You can see here, like I said, look at this. This is where the 168 number comes in. Boom. They decided to depreciate a shit ton of their acquisitions. So in general, this is looking weird right now. So like I said, the 2 red flags what was up here, and remember how I said before was stock appreciation. I'm not going to count that. The huge amount of cash paid for acquisitions, I don't give a fuck about that because you overpaid for it and everything dies. So in other words, I'm going to add back in I'm going to take the 2019 numbers and then add back in about, let's say, 100 million into this. So purchase of marketable securities, blah, 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 everything else. And then financing just means, hey, how much stock did we sell in order to finance our shit? So basically, this means that when I see something like this, issuance of stock, I'm going to be expecting that the company issued a shit ton of stock in order to finance themselves. So in other words, I'm basically seeing this and saying, I'm looking at this and saying, okay, well, I might get diluted as fuck depending on the number of shares. I would need to look at the share growth over time. And because, let's say, for instance, let me simplify this example. So let's say that there are 100 people that own the company, right? And the company is over, like, let's say $100 million, right? That means each person owns $1 million of equity. Now, let's say we bring in another 100 investors. Now, that equity gets split up even further. Now, each person doesn't own 1 million. Each person owns $500,000. So you can see here, by bringing more investors in, they dilute the existing investors in order to bring in more money. That's just kind of the way it works here. So a high number like this just kind of means, hey, wait a minute, something's not right. So I'm basically going to be looking for stock dilution, and I'm going to be looking for, because I think the company was trying to capitalize on this stock-based compensation growth, which was caused by the rocketing of Snapchat stock. And then I'm also going to be adding this back in. So let's actually look at the selected financial data. Let's see if we can look at this operating and just confirm if I was right. So consolidated statements of operation data. Great. Let's take a look. So you can see here, like in the past 5 years, they show you that they're basically operating at a loss of around $1 billion per year. So basically, I was right. Yeah, the 2019 numbers seem pretty representative. You can distribute this like $3 billion. This $3 billion back into this 2016 numbers, and then average it out. It comes out to be $1 billion and $2 I don't know. This I just off the top of my head. So let's look at this revenue. So the revenues are increasing. Great, perfect, fine. But their costs are increasing too. Like what the fuck? Why their costs are basically keeping up with the amount of money they bring in. So this is not great. Why the fuck is this happening? I'm very scared in general because like what you'll find about tech is that incrementally it should not be that much harder to add the next customer. The reason why is because you've already built out the software, and so onboarding one more user should just be automatic. So let me give you an example. So let's say I have like my Verizon stock, right? Verizon already built out all the infrastructure with all the cables, with all the internet, everything. So bringing in one more person to using the network should cost me like literally $0. Even though they might charge you like an activation fee, it's literally just I'll just rent out an additional box to them, and then they set up on their own. Boom, they're good to go. I've already built out everything. Adding one more user, I don't give a fuck about it. So that's Verizon. And basically that's the same thing for any software company. So cost of revenue. I don't know why this is going up so fucking much so fast. That's a big red flag. R&D, okay, fine. I can accept this one. This one I'm perfectly okay with actually. Because in general, when you start doing some cutting edge shit, you're going to be doing research and development. So Facebook's going to be doing this, and you're going to see this across the board in tech companies. So I do like this at least. Sales and marketing. Holy fuck. In other words, you're looking at this, you see revenue grow like by 5-6x, but then you see that sales and marketing basically grow like by 4 or 5x. So in other words, a big majority that's driving the revenue is not the fact that they can bring in people on their own. It's the fact that they have to basically push their marketing and sales to the nth degree. It basically means that they make their money not by creating value, they make their money by marketing the fuck out of this product. So if that's that's basically where we start coming in to looking at the this is basically like what I kind of suspect, like why is, even though like this revenue thing, like why is this so big, right? And then one of the other things I wanted to mention was like the what was it? It was the minus 3 million or something. What this is page 45, right? Let me come back to this. Let me look at the cash flow statement again. There was one other point I wanted to make and I totally forgot. Where's the consolidated financial statements? Cash flow. Yeah, there's like there's something here about like was it depreciation? Was it depreciation I was mentioning before? Not purchase of marketable securities. It was one other thing. I know I mentioned it before. It was like a $300 million. I think I mentioned $300 million or something. Yeah. Purchase of property, plant, and equipment. Yeah. So this is capital expenditures. So basically, remember what we looked at before. This 36 million number. Remember this. $36 million in 2019 would have been. So let's say what? 36 divided by 17. 36 divided by 1700. That's basically a 2%. 2%. They're reinvesting 2% of their revenue back into themselves. I mean, yeah. In general, you can say like, oh, research and development and physical and they're gonna justify it by saying, oh, we already include that in research and development. Okay, but I don't like seeing that. It's like, okay, fine, but then if half your money goes back into research and development, right? That's not a good sign. If you have to take most of your cash flow and then take half of that and then reinvest into yourself just to keep things going, not that efficient. Again, keep in mind, like Facebook and Apple basically operate at like when this number is like 15%. So this shit is like fucking garbanzo beans to me. Like I don't get it. Like even if you want to write that story, it just doesn't make sense. Why would you want to work for a company that spends 50% of its budget just to keep the lights on, just to keep its product moving forward? Not great. That's basically not a. And keep in mind, like the company needs to invest in itself before it pays its employees, before it pays its shareholders, before it pays equity owners, which we are when we are stockholder owners, right? Because the way the money works is like you pay the business, right? You reinvest in yourself, you depreciate all the assets, you buy more assets like your factories and stuff, and then you pay off your debts, and then the money flows to us as the shareholders. You know? Oh yeah, and the government also takes a big chunk out of that too. So. But there's so many other mouths that get fed before we come to us. And for the business to just have to like force itself to basically pay for more research and capital expenditures to this degree just to keep the lights on before we even see a dime is not a good sign. So that's basically the story here. So net loss, blah blah blah, interest income and expenses. You basically see here like they're basically operating their operating losses. Not good. So basically, I'm seeing this and I'm thinking, this is ugly as fuck. And so what the company what I'm going to predict is that I think the company is going to say, hey, using adjusted EBITDA, we're going to look at these revenues. We're going to ignore all the expenses here. And we're going to say, hey, in 5 years, we're going to be growing to profitability, So they'll probably say like, hey, we're growing 25% year over year using these revenue numbers. And I'm only saying this because I've read brochures and like so many companies' decks like this so much. But basically, the question is, looking at this consolidated operations data, do you believe that even at a 25% year over year annual growth, do you think, one, that's going to happen? And two, do you think the cost of research and development will basically catch up to it and keep it sustainable going forward in the future? Those are two questions that you need to ask yourself when you decide to work when you see shit like this. And keep in mind, it's much harder to grow once you grow. The bigger you get, the harder it is to grow. So let me give you an example. If I ran a local pizza shop, like in my neighborhood, right, and that thing pulled in $100,000 a year, in terms of gross sales. It's gonna be so much easier for me to go from 100 to 200,000 because all that means is like, if I live in the Bay Area, then I'm just gonna convince people in say like the next town over, hey, come to my pizza shop, and then boom, that doubles my revenue. But if we're talking about like global scale and you're already operating at billions of dollars, well, what does it take to double your money or grow by 25%? Do you need 25% more people on the platform, or do you need to? Like if you're already everywhere except maybe one country, that means that the only way you can easily get that next 25% of growth is to invade that fucking country with your products. In which case, it's probably like South Africa, I think, or once they get their infrastructure up and running. And that's really fucking hard compared to just convincing people in the next town over to buy your fucking pizza. So this is basically the story I see here. Is that if you decide to work for Snap, you're investing your time into a company that is basically like, yeah, we're gonna maybe get there, but we're mostly just gonna do it based off of marketing. So you need to basically believe in the marketing machine of Snap if you want to work for this company and you think it's a good company, and you want your stock to grow in the future. So in general, how would you value this? Well, there's a few ways. You can value it based on like price to earnings, but earnings are negative, so you can't do that. So you have to do price to like some revenue shit, which gets really weird. You can do price to book value, but let's look at FinViz, because this is actually a tool I use. So let me bring this over here. So let's look at the metrics here. Unfortunately, FinViz calculates this from the year forward. So you can see here, price to earnings, fucking nothing because it's negative. So you cannot calculate price to earnings. That wouldn't work. Forward, 67 times price to earnings. So what does this mean? Price to earnings just means the amount. You can approximate it as the number of years it takes for us to get our money back. So let's say that like Snap is let's say Snap is currently like at 62 billion, right? And I decide to buy the business today for as it is. It would take 67 years of Snap earnings at its current level for me to recoup the money that I paid for the business. That's what this number means, basically. I mean, there's also EV to EBITDA as well, but that's a whole nother story. But for now, you can just approximate price to earnings as that much. Price to book. So you remember, like I said, there's about $2.5 billion of like actual net book value or something like that. Yeah, you multiply that by 20 times, you'll probably get to like the $62 billion market cap or something like that. But in general, remember what I said before. If I took out the Goodwill, if I took out all the net intangibles, you only arrive at $1 billion. So that actually is in line with price to earnings. So it's not something that you can actually use. So how then would you value Snap? You probably have to use like free cash flow, but there's no cash available to the equity owners because you're operating at a loss, so you can't really do that. So you have to use basically the revenue numbers from EBITDA in order to value the business, which at that point, to me, I'm going to say if you have to use EBITDA to value a business, I'm going to say go fuck yourself. You cannot do that. It's like, again, like I said before at the very beginning, what business doesn't take into account depreciation, taxes, and amortization? So, I mean, you can do that, but only if you really, really believe in the narrative. And that's all I'll say about that. In short, I don't believe this price target, but basically, this is the way you would want to look at a business. So having said that, the reason why I want to pivot to a more important point. I want to actually show you like basically what it would have liked to work for Microsoft in like the tech bubble, right? In 2000. So if you remember, like in 2000, we basically just ended up in some really big ass weird tech bubble, right? And everyone's saying, "Oh my God, we're in a tech bubble today." Like Apple's trading at like 35 times the earnings. Yeah, actually, I think Apple is actually. Yeah, it's trading like at 30 times earnings. And as much as I fucking love the stock, I can't justify this valuation. Like, I'll tell you what, I think everyone who knows me knows that I'm fucking leveraged to the tits in Apple. Like, straight up. Because I think this company is fucking fantastic. It's absolutely brilliant. But I would encourage you to really do your own due diligence like I've done here and ignore the fucking price analysts. Like, once you could do what I just did in like an hour, you can actually just do this all yourself. So as much as I like this, I cannot justify paying $2.8 trillion for this, or I cannot waiting 30 years for Apple to give me my money back. Maybe not. I don't think I could do that. So that's basically the reason why I'm bringing this up. Like, oh my God, we're in another tech bubble. Everything's so overvalued. So I want to actually show you something. So this is taken from cashflowinvesting.com. I highly recommend that if you want to like spend like a weekend learning about cash flows and learning how to actually value companies on like a cash by cash basis and get really started into learning about companies, I would recommend like the Cameron Stewart course. I think it's a great introductory course. It's $20, but I think what I really like is that he actually goes through some of the very basic information, and the way he presents it I think is a lot better than a lot of other places that will try to do it as like a university course. I think the way he does it is like it's basically a 5-hour course. But but he presents it in such a really fantastic way. I don't think you can really pay much for that, but I do appreciate it. Of course, you're free to like go to what's it called Udemy and pay for like a course for company analysis as well. I think that's also fantastic. But I'm just taking this because I personally like it. So notice here Microsoft corporations, right? 1990. Suppose that this is when it IPO'd, right? Debt. Didn't have any, right? Cash flow from operations. This is all the money that they're making from all the the operation stuff that we saw before. You can see here, every single fucking year they're growing. No questions asked. No adjusted EBITDA bullshit here. No negatives, right? And then every year they're investing like capex here. They're investing a fuck ton of money. In the beginning, of course, you're spending like 50%, right? But then you notice here, like in 2007, they've reduced it to like maybe like 5-10%, right? And then you can see here like. Now it's still like 20%. So it's not as high. In the beginning, it was like very, very high. Like 50% of their money went back into itself. But that's only because they recently IPO'd. So, but then now you reach a point where you basically only spend like 5% to sustain yourself. But we'll see why this is the case later on. Chemistry course, no. So look at cash flow investing. Google that. It's by Cameron Stewart. In fact, the link is up here. So capex. Remember what I said. Capital expenditures. The money the company needs to pay itself. So debt payments. How much debt has this company taken on? Well, nothing. For the fucking first 15 years of its life, Microsoft, nothing. So how the fuck can like all these like Snapchat, the Snapchat growth company, whatever, is in a fuck ton of debt, not making money from its operations? And I'll have a little explanation of this why later on. It's basically low interest rates that makes this actually worth the risk. So next thing. Free cash flow to equity. So remember what I said before, that the money needs to flow to the business, then needs to flow to government, business, debt holders, then us. Basically, that's us. So you also see like free cash flow to firm, which just means the money that goes into the business before it reaches the debt holders. This is basically, you can read this as, hey, if there is debt, then this number versus free cash flow to firm will be different. But if there's no debt, then these numbers basically operate the same. So so in general, you want to look for companies that have little or no debt compared to like the amount of money they rake in. Apple's a great example. They might have debt on their books, but they rake in like fucking $100 billion every single year. So if they pay like let's say I think it's like 10 million a year in debt, who the fuck cares? So that's basically what it is. So you can see here like shares has been also like steadily increasing, but it's like maybe like what? This is like 2% per year. Okay, it's not super terrible. In fact, like in the first year, they actually bought back their own shares. That's surprising. But you can see here, like every single year, they've like kind of bought back. They have these shares like massively diluted to take advantage of the what's called the tech bubble, and then they just like fucking buy back their own shares. Ever since 2006, They've been buying back their own shares, and they're still fucking buying back. Over the course of like 10, 12 years, literally, they have basically increased the value of that company almost like 25% or 30% just through simply buying back shares. What does share buyback do? Instead of like, there's two ways you can do this. One, you can increase your revenues and then pay a shit ton of that to to the company and to the government in taxes, right? So let's say I grow my revenue by 25% and then I pay 50% in taxes, right? So let's say I'm bringing $100,000 in my business, right? And then I decide next year I bring in $125,000, right? And let's say my tax rate is like 50% for the sake of argument, right? So that additional $25,000 in revenue now becomes $12,000 in revenue. So that means effectively I've only grown my business by 12% on 25% more business. The other way I can raise money and increase the value of my business is by taking away shareholders, right? Remember how I said, hey, if I bring in shareholders, I dilute the business? This is just the opposite of that. And this is tax-free. So you really want to see companies that do this, that buy back their own shares. That means that management thinks that company's underpriced. And first and second, this is all tax-free. So the money, like you see like 30% year-over-year growth. Well, this is one really big reason why. Like 10% of it is literally because the company buys back its own shares tax-free. They're not growing at like 60% year-over-year revenue necessarily. I think they are, but another part of it is that they buy back their own shares tax-free. Now this is really fucking fantastic to see. If you see a company buy back its own shares, it's fucking great, right? So then you can see like how much like price per share and then the free cash flow yield per share. So you can see like in 2010, it was fucking great, 14%. 14% free cash flow. This basically means like if I buy this stock, I am getting 14% year over year. Fucking phenomenal. Another thing you want to see here and this I'm talking about Microsoft because it's a fantastic business. That you can see cash flow from operations every single year, growing. There's never really been a number or time when this number really like decreases. I think the only exception here is like 26, 31, 28, 32, 29, 33. You can see like it kind of gets in a rut here. But that's like Mr. Steve Ballmer shit, right? But then Satya Nadella goes here, reinvests in the fucking cloud business, and then go, boom. Like, look at this shit. Every single fucking year, doesn't matter good time or bad time, they basically stayed the same or gone up in revenue. Even in fucking 2000, like, oh my god, tech company bubble, blah, blah, blah. Oh, 2006, 2007, 2008. Oh my god, the world's ending. Like Lehman Brothers, end of the world. Still fucking growing. You want to be in a business like this because if, it's not a matter of if a market crashes, it's when. But no one can tell you when. It could be 1 year, 2 years, 10 years down the road. You want to be involved with a company that can still grow its fucking cash flow from operations like this consistently year over year. It doesn't matter. It basically means that it's more likely to do this because it's done this in the past. Shout out to whoever fucking is managing Microsoft, man. They're doing a fucking good job. So anyway, now having chalked that up, let's actually look at other things here. You see here, like, the revenues that they brought in. It tells the exact same story. EBITDA. I know people, I don't like using EBITDA. I know he likes using it. But in general, you want to see, like, the reported income to be similar to like what you see from cash flow for operations and revenue. It's basically an indicator saying, hey, yeah, most of our money comes from our operations, not from like, remember the three ways that we can grow money as a company. We can invest, we can run our own business, or we can sell debt. We can invest or like buy stuff on the market. So seeing revenue and from operations grow in line with EBITDA is a very good sign that all our earnings are coming from operations and from ourselves, from our ability to produce our own money, not from debt, not from investing or anything else. So debt-wise, same thing. As long as this number isn't like completely unwieldy compared to like their book value, I don't give a fuck. So this is fine. Considering like this $80 billion in debt, it's like it's a little bit high for my taste, but I understand why they're doing this. In fact, they're basically just saying, hey, yeah, zero interest rates. Let's boom our debt. It's basically what they've said here. That's the story I'm giving it to this. Because up until then, 1990 to 2010, not much debt at all compared to like the revenues that they're bringing in. Right now, debt is cheap, so that's why they're loading it up on their books. So, but the thing is that I don't care because, you notice like in Snap, I gave them like a fuck ton of shit for that because they basically just ended up saying, oh yeah, we're not profitable, but let's take on more debt. But for Microsoft, they're saying we're profitable, we're growing every single year, let's take on more debt because we know we can still do this. You see how there's a very big difference here? So, in other words, Microsoft, And even now, like, even though debt is like super cheap, they're managing it. They are chopping that shit down, and they're paying it off. So there's no reason for me to really care. In fact, look at this excess cash. Look at this fucking excess cash that they're holding. Like, they can pay this off, like, immediately, tomorrow. Like, say tomorrow the apocalypse is fucking coming, right? Oh, no, you need to pay your debts. Okay, great, we have the money to do it. Who cares? Again, same thing. But if you look at Snapchat, they're not going to be able to fucking do that. So, in other words, not only is this revenue thing a good peace of mind, it's also this excess cash that's sitting around as well. So, you can actually, if you can pay off your debt immediately, I'm not concerned. So you can, and if you go to their Microsoft 10K, you can look at current assets and then current receivables, or current liabilities, and then net those, and if they cancel each other out, chances are that it's a pretty good sign. And then also you can do the whole exercise of subtracting the intangibles as well. Or even, like, you can do so any variations of this. But the point is, if you can think of a way that the Microsoft can immediately pay off all its debts tomorrow, all its long-term debts tomorrow, then chances are it's a great business. And it knows what the fuck it's doing. So then, market capitalization, EV. So you see like this EV, EBITDA. So enterprise value. What the heck is enterprise value? Enterprise value means that if I buy the company today, all its shares, all its books, all its like the book value stuff, so the cash that it owns, and all its liabilities, I added that all together. That is based on the market cap. So you can see here like EV and EBITDA, EV and market cap, pretty much aligned hand to hand. What does this mean? This means that net cash to debt is basically neutral. So, which is a very good sign. Which means that, hey, I am not burdened by my debt. If a company took on a shit ton of debt, you would see the enterprise value be much, much lower. So then we come to EV to EBITDA. Remember how I said before, price to earnings is one proxy for seeing how long it would take for you to get your money back if you bought the business? EV to EBITDA is basically the exact same thing. Except the only difference is that, like I said, you're counting into interest, taxes, depreciation, and amortization. And then EV is just all the shares net the assets and liabilities. So the only way the EV and EV to EBITDA become different compared to price to earnings is when you pay a significant amount of taxes, depreciation, or amortization, or you have a significant amount of debt. For most tech companies, really, this only boils down to the amount of debt that you owe, because depreciation and amortization should never be much, because one, software companies don't last that long in general. And two, you should have a lot of computers that you need to depreciate. So you don't necessarily need this, but you should be concerned if EV to EBITDA actually just like is completely out of line with price to earnings. So going back to Snap, let's look at FinViz again. So do they have EV to EBITDA? Maybe they don't. Okay, I guess they don't. But I guess we can do this calculation later on. Actually, maybe let me see if oh yeah, Yahoo Finance to the rescue. Great. So if I look at enterprise value, right? EV to EBITDA for Snapchat, like you can see here, like it's currently like 177, like it's way down, right? Price it's like a negative 177, right? And then if I go to like the price to earnings here, 6-7 times. So in other words, this company's loaded itself off with a fuck ton of debt. So that's basically one way you can look at this. And notice here, like I said that before, like when I saw the earnings and depreciation and I saw all the acquisitions, I saw the change in book value. I said that earlier in the stream, and I didn't even have access to these numbers. I randomly picked Snap because someone fucking said, right? But you can notice here, like if you apply a very simple story to it, 99 times out of 100, it's always true. So you can actually do that. But let's look at this. Remember, the whole reason we look at Microsoft was because of 2000, right? You can see here, Microsoft was trading at 41 fucking times its earnings. Its EV to EBITDA ratio. And this is like height of the tech bubble, right? So you can see here, holy fuck. This is like way out of line. It's like we're at 1998 levels, right? 1999, 2000, 2001. You can see like the bubble pop, and then the Microsoft probably lose like half its multiple, probably lose like half its value or some shit, right? So you can see here, oh my god, like the market multiples are just like so bad. Again, you consider this like based on what the market feels. This is just a sentiment metric. It's basically what the market thinks that, hey, I am willing to wait X number of years in order to get my money back. But that's completely subjective. Some people might be only want to wait 1 year. Some people want to wait 10 years. This is just basically a sentiment metric. So you can see here, like, this kind of tracks the sentiment of the market pretty closely. You can see here, like, throughout all of, like, 2001, it goes to, like, 19, 15, 20, 21, and then, like, 2006, 2007. It kind of settles in here, and then, boom, 2008 to 11. Everyone is fucking shitting their pants. Everyone is fucking shitting their pants right now because of it. And so, if you look at this, it just means that, it's traded at 6 times. A fantastic company that continually grows its fucking revenue every single year. Like, it's trading at 6 times earnings. That's fucking fantastic. If I'm a actual investor, I'm looking to buy a shit ton of stock right now for Microsoft. So let's look back at the shares, right? Notice there in 2006, 2007, 2008, they thought that it was like completely undervalued, and then they decided to keep buying more. So let's see what happened in 2006. 2006. So they think that 11 times multiple is like, it doesn't matter. Like, they think the market is completely undervaluing it. So you can see here, like, they just keep buying back their own fucking shares. Pretty easy. Oh, hey Trent, what's up? So you decided to join me for the finance shit. So let's actually look at this. So I'm actually going to ignore this. I think this is something that you could do on your own, but I really want to look at, like, the Microsoft stock price, actually. Actually, no, I take that back. You know what? This is basically him projecting using EBITDA and free cash flow to equity, and then trying to value the company that he thinks that there's going to be like a 17% year-over-year return based on past performance. So what I want to do is actually show, like, on the Microsoft stock. So look at this. So you can see here, like, it's trading at 20 cents, and at the peak it's like $55, right? And you can see here, like, it just basically hovers around like $20 to $25 for like a fucking decade. So would you have joined, let's assume that you joined Microsoft in 2000, right? It would basically take you about 15 years for you to recover from that. But during this time, Microsoft is completely undervalued, right? So would you basically take would you basically work for Microsoft for 20 years if you got here? Arguably, yeah, if you knew it was going to 6 times. I mean, it's not that bad, honestly. Like, even if you saw this shit, like, you just, like, go around, quit the company in 2 years, go work for someone else, come back in, like, 5 years, and then just join them, like 10 years later. It's still kind of the same story. But my point here is that when you see a company that is, like, a very solid company, and you want to hedge your bets, like, again, this is, like, some freak shit. This is some freak anomaly shit that happens, like, once in a blue moon. But for the most part, you can be generally protected in, like, 20, 30 years. But so this is why I'm saying Microsoft and these FANG companies, like, I still think they're somewhat undervalued, actually. Even at the multiples they're trading at, they're, like, undervalued just like maybe by 5% or trading at value. And so what you can do, that's why I highly recommend working for, like, companies that are actually profitable and that consistently show revenue growth year after year. So is that you're going to be protected from shit like this. I can tell you right now, anyone who's working for, like, an unprofitable or, like, a unicorn tech company that has fucking high multiples is shitting their pants right now. If they're worried about, like, their money and pay. So I still think that it's still in your best interest if you are early in your career. I still think it's okay for you to work for, like, unicorn and unprofitable companies. The reason why is because the experience that you'll gain and the upward mobility eventually will set you up for later in life when money actually starts really mattering. When you really need, oh shit, I need that financial security. I really need to do this because ultimately you can always sell your stock and then just buy Microsoft stock when invest. If you really are that concerned with your wealth and trying to make sure that your investments go in the right place, that's something that you can do. Yeah. I mean, I would say that the past 2016 to 2021, you'll probably never see this shit ever again in your lives. Just saying. But I still think that and I don't know. Like, I'm just some random fucking guy, right? Like, whenever an analyst talks about the future, they're only able to project using the past 3 to 6 months, right? So based on the financial data I've seen, I think that Microsoft stock is still a very solid buy for its future. The price action for it, I cannot tell you. But I think that if you're valuing it on a quality business, I think it's fair. I think it's fair to buy it at its current price. Trent says, bro, if you're this into finance, you just become a quant. No. The thing is that quants basically just try to take advantage of, like, what's it called? The price swings. So let's actually look at ARK. This is, like, the fucking favorite that me and Brad loves to fucking hate. Bread Cat Bounce in our server, right? So you can see here, like, in the past fucking year, it took this enormous fucking shit because everyone realized, oh wait, this is actually a really shit company. There's a really shit ETF with really shit stocks that are unprofitable, and we don't believe in it anymore. So when you deal with growth stocks that are way high above their multiples, you're basically taking advantage of investor sentiment, and then basically like some random shit that like volatility. You're basically taking advantage of like time expiration and a bunch of these really really exotic derivatives that I couldn't tell you like much about. I know how basically how they work, but I couldn't tell you how to predict them. Breadcat Bounce is super good at this actually. But the reason why I bring this up is because quants are basically required to perform year after year, right? So notice like in the Microsoft example, it basically took it 15 years for it to get back to its fair value and explode 6x. Now, if you're a normal investor with fucking 10, 20, 30 years out for your timeline, that's gonna be fine. Because let's take the S&P 500, right? Let's say we take like from let's say 2000, right? Let's say you got invested at the worst fucking time in the S&P, $1,500, right? You only go up 3x in 20 years. Microsoft went up 6x. It's still worth it for you to have invested in Microsoft compared to like the overall stock market. But the reason why I say this is because if you had invested in Microsoft for like let's say like during this amount of time, and then you held your position for 10 years, you held a 50% loss for 10 years, you would be fucking fired. Your job as a quant is to take advantage of like the short-term trends because the incentives are like you're paying out on year after year after year over and over, right? So it's basically how you perform from January 1st to December 31st. So it's an arbitrary date essentially set based on the working year. So that's kind of the problem with quants is that you need to be able to predict these trends. Now, the financial analysis that I just gave is like purely based on company value, based on the value of the business itself, right? And most times, people don't know how to read a fucking 10K. People don't pay attention to these stocks. People just trade and invest based on feeling. They don't do any kind of objective analysis, like based on the numbers. They just say, oh, I think it's going to go up. I think it's going to go down. I think ARK is fantastic. I think Kathy Wood's a genius. And then here, oh, Kathy Wood's not a genius. I don't believe in her anymore. And as a quant, your job is to actually trade on that. I can't fucking do that. I do not have the brains or the willpower to do that. Occasionally I can. So for instance, like one of the ways that you can tell, like I'll give you an example of a play I did with Breadcat Bounce on this. Basically, we took advantage of like the Christmas rally in the past, like I think it was like the past month, right? So you can see here, like if I go with the S&P 500 in the past month, you can see here like between 23rd, 24th, 25th, it rallied and then took a dip. But then what I noticed during this time is that a lot of the capital went to like low beta stocks like Coca-Cola, Domino's, Apple. Apple was not Apple, but like a bunch of stocks that are not correlated with the stock market. So basically, low beta just means how correlated you are with stock, and if you're with stock market, how much you rely on the S&P and overall stock market for your growth. But basically, I noticed that, and I'm like wondering, wait a minute, how can we be growing? How can consumer sentiment be positive if companies like if ETFs like ARK and Tesla are just treading water, and then we have all this capital going into low beta stocks? It means that the market is predicting that, oh shit, we're gonna take another dive. And so basically, we bought like puts, like literally like I think around here, but he bought it like up here as well for longer dated. I bought mine shorter dated, but essentially we came out with it like a 45% gain on just buying ARK puts because it shit the bed so hard in the past like 2 days. At least to me, but he had the foresight to actually recognize this a little bit further out. So he might have paid a little bit more in theta premium and theta decay. But the bottom line is that if you understand the fundamentals of how markets work, you can just kind of see like how and why these things can be volatile in the short run and how you can get totally fucked on your comp. All right, I see we're dropping viewers. Are there any questions about anything I've talked about so far? Because I think I've pretty much like talked about most of the big points. Okay, I see like thoughts on a firm. I haven't read their 10K, but let's do like a very, like I said, I'm just going to FinViz. I highly suggest you do this exercise yourself with a firm, and look at like oh, it's another one of these fucking money losing companies. I'm basically gonna say I would not join it. I don't know what let's see what the IPO'd at. Okay, IPO'd at around 100, and then shit the bed. Yeah. Shit the fucking bed. December rally, and shit. Holy fuck. I don't know if I would short the shit out of this anymore. I think it's basically hit like a point where it's just gonna tread water, but I can't honestly tell. This is so fucking funny. So, anyone who... actually, you know what? The last domino to fall before you see any kind of crap will be Tesla. Look at this. Look. Even though, like, everyone's been, like... It's been treading water. It's been holding water for, like, a really long time. Even in November, December. So, to me, like, I still think that this is the last domino to fall. When you see everyone give up on Tesla, you've officially entered bear market territory. The reason why I would not try to buy puts on Tesla despite like everything I've said, is because there's just too much action on this. Everyone just believes in it too much, and I'm not betting against the market like that. Nor do I really like taking the short side of the market, because the short version is that when you transact in the market, you're basically paying a premium for the spread and for the transaction. So in other words, even though like for every single asset you buy, there has to be someone that sells, right? But because of the commissions, there's actually three parties: the broker, the buyer, and seller. So in other words, in order for you to make money, you need to make back the money that you transacted, the asset value, plus the broker fees that you paid. In other words, you need to bet that the stock is going to go up. So in other words, it's not 50-50 distribution of wealth. It's actually, you need to bet 53% on the bull market on the bull side in order to come out favorable. That's kind of the way things work, because there's more incentive for people to actually buy better shit, more quality shit, when they know they're being charged a fee to do it. And this kind of goes into like why Berkshire Hathaway, if you look at Berkshire stock, it's trading at like fucking, like, I'm not joking when I say that it's trading at almost like $500,000 for a single share of Berk. Why wouldn't they split it up? Is because then the people who are going to be buying Berkshire are just going to be like buying, selling, and then basically what ends up happening is that you pay 2-3% of the market cap of Berkshire to commissions, to people who are just basically trading these like it's a fucking racehorse and gambling on the stock. So, in other words, I don't think Berkshire really wants to give up 2-3% of its capital over to Goldman Sachs. I don't think it's in their interest to do that. And so they really want high quality holders of stock. So if you're buying Berkshire, you're really buying into Berkshire for the long term, not just because of the high price, but the high price also demands a high level of liquidity. And remember what I said about premiums. There's like there's 5 premiums that you need to consider. You need to consider the initial rate of return, which is like which is in most people's case, the stock needs to beat the S&P. You need to factor in inflation. So okay, well, you need to have an inflation premium on top of that. So that's your nominal interest rate, and then you also have the liquidity rate, which means that if the stock is just not being traded at all, you might not get a good price for it. You also have the default premium, which is how likely the company is to, like not give you back your money once you've invested in it. And then you also have I said default, I said liquidity, and then I said, what's the last one? Yeah, default, I said default, liquidity, and then, God, why can't I remember it? Fuck, I actually need to look this up, god damn it. Wait, hold on. I know I had this written on a paper somewhere. I'll be right back. God damn it. Right, maturity premium. God damn it. I should know this one. Maturity is just like how long you hold the stock, because it's like if you hold a stock for for a long time, there's a lot that can go wrong. So, in other words, if you are going to hold stock for 20 years, you need to demand a greater rate of return, because, you can always, this is basically any asset, or basically any kind of, any kind of equity. I need to be compensated for holding on to your fucking stock for a very long time. So, in other words, you need to basically factor all these into account. I mean, there's also like a bunch of other things that you can consider, like volatility when you're trading short term, because, like, for instance, markets would rather take a steady 10% than a very choppy 11%. Like, for instance, if the stock goes up 50% one day, down 49% another day, and then just does that, markets fucking hate that. And there'll be a drag on the price because of it. But if a company can just grow like 1% every single day, people will fucking love that, because it's very predictable. People love predictability over volatility. So those are the things you need to consider when looking at like price actions. and things. But overall, don't worry about the fucking price action. I still think that the best way to evaluate a company is like do what I did. Notice like I took an hour just to explain it. But if you get like evenly halfway decent at it, you can do this in like 10 minutes. Like I guarantee you, Warren Buffett does this in like fucking like a minute because like he's done this his entire fucking life. And I just do this as for fun, and it only takes me like 10 minutes. So you can spare 30 minutes just to actually do this yourself. And of course, Investopedia is there to help you look at these numbers and what these mean. But notice, like every single time I talked about like a particular like number discrepancy, I think, oh wait a minute, I've seen this before. I saw like a huge jump in the Goodwill, right? And I thought, hey, wait a minute, that Goodwill increase. Either management has inflated their brand value, or they acquired a shit ton of companies. Lo and behold, they basically acquired $160 million in companies. So, yeah, I'm telling you, like it's not difficult to do this. And I think if most software engineers actually started reading these companies, I think they would demand a much higher salary from these companies as well. So, are there any other questions in the chat? I notice the chat's a little bit dead right now. And actually, this was like the first time I actually looked at the Snapchat 10K. Like I noticed I didn't like. There's 200 fucking pages here, right? There's 200 fucking pages here. I only need to look at like what, maybe 5 pages to get the full story. So like I said before, like a lot of this shit is just like legalese. The only thing you really need to look at is the financial statements, and then look at the number changes, and then just see, hey, wait a minute, why is this number here? Why is this change here? Here's this random fucking section. Evaluation of disclosures and procedures. Our management with participation of our CEO and CFO has evaluated the effectiveness of our disclosure and control based on blah, 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 blah. We followed the rules. It's basically just saying we followed the fucking rules. Okay, thank you very much for telling me that. And then, like this one is like the name of the executive officers. I think it's good to know, at least like you should know the CEO and then maybe the CTO. But other than that, like, not really useful. Like, I mean, like, I guess, like, if you want to evaluate things from a management side, you could just, like, Google their name. Let's Google this motherfucker. Let's see what he says. He's 30 years old, and he's running this company at a loss. So, let's see, is this guy actually, trustworthy? Because I think one of the things that you need to keep in mind is that even though the business numbers don't lie like this, you also need to make sure that management knows what the fuck they're doing. So, for instance, and so it's really helpful to look at the past history of these guys to see what they've done at other companies before they came to the company that they're working at, right? And so you need, because chances are what they do in a previous company, they're going to be doing exactly here. So, for instance, if let's say the CFO decides on a strategy of constantly acquiring companies let's say he was working as some, maybe travel, let's say in the past he did this shit at Allstate, right? And I'm giving a random example. And then he basically, during his time at Allstate, the company decided to just acquire a shit ton of companies. Then chances are he's going to bring that over here. So when you look at these executive officers, you want to look at their past. So let's see what the CFO of this guy does. Derek Anderson, LinkedIn, co-founder, CEO. Snap. Let's look at his employment history. Link to LinkedIn we go, boys. Okay. So he's worked at Amazon for 7 years before that. Before that, he worked at Fox. He went back for an MBA. He has a CFA holder. He graduated in 2000, valedictorian. Okay, so it looks like... What the fuck was he doing between 2000 and 2007? I guess he worked at finance. I guess it's like some no-name companies before he became the VP of finance at Fox, and then became finance at Amazon, right? So finance leader for Prime Video. Okay, so then the question now is what the fuck did he do at Amazon? I don't care. Hires. Yeah. Okay. So we know we worked on Prime Video, right? Amazon Prime, in the last 7 years. Then we have to look at something like Prime Video, Amazon in the past 7 years or past decade. So let's look for news articles in 2012 or let's say 2015. So that's just, yeah, let's read the Wikipedia article. In 2017, they announced anime strike. Okay, so this guy likes anime, hopefully. Began making sports-related acquisitions. Okay, cool. So we found it. So notice here, like, I think this is probably towards the end of his tenure, but basically Amazon began making a bunch of sports-related content acquisitions. So they're doing content acquisition. It's funny because it looks like Snap is doing a bunch of acquisitions here, right? Let's say Snap acquisitions, right? List of acquired companies. 2020 acquisitions. Oh, 2018. Okay, they acquired some stuff in 2017 too. But then, like, for the longest time, they didn't actually do it. So you might see this as like, okay, well, maybe it's not him that's bringing this in, because you notice here, like, if you look at the kind of acquisitions they did, they acquired like 6 or 7 fucking companies in 2016. So maybe this is not the guy you want to be worried about. So or maybe it's the guy before him. Who knows? But essentially, there's someone else here who is doing that. So I would say the next best guy is probably the business officer and strategy officer. And you can repeat this exercise actually for any one of these people. But basically, do a Google search on these executive officers. Like, who the fuck are they, and what the fuck did they do with their previous company? Because once you understand that, you'll actually understand like how that plays into the story of where the current company is going. So let's do that. Actually, I want to say your Gus Snapchat. Chief Strategy Officer. All right, he worked as a adjunct professor, blah blah blah. CEO of Huffington Post. Okay, so let's see what he did in let's see what he did at Huffington Post in 2015 to 2018. Huffington Post Wikipedia. So let's see what they did between. What was the fuck was it? Not Derek Anderson. Did I lose the guy? Did I lose the motherfucker? Board director. Okay, 2015 and 2018 of Verizon Media, CEO of Huffington Post. 2015 to 2018. Okay, Ariana Huffington resigned. 2017 rebranding to HuffPost. Verizon Media laying off its staff. Wait. Oh, 2015 to 2018. Okay, so basically he is September. Okay, so there's nothing noteworthy. I can't pull up anything he did at Huffington Post. Yeah, okay. Yeah, I guess at that point it was already what's it called? It was already acquired by Verizon. So head of corporate development, leads several of the most innovative companies. Mentor, angel investor in startups. Slams Yahoo News. Okay. Okay, so in other words, the last guy you want to look at it would probably be this guy. Jared Grutz. But not Jared Grutz, but wait, yeah, this Jeremy guy. Jeremy Gorman? Let's see if we can let's look at him, see if he's the guy influencing. Oh, she, my bad. Jeremy with an I. Oh, ad sales. Ha! Okay, business officer completely in ads. Ah! We might have found it. So, if we look at this, if Snapchat is making most of their money from advertising, then she's probably the reason. Because, there's many different ways to become the chief business officer, but it looks like, now if you look at Snapchat, looks like it's mostly ad tech. So let's actually dive a little bit deeper into the 10K. Let's see where the revenues come from. I think select financial data, right? Revenue, marketable securities. Notice the moment I came up advertising, 233 results for advertising. Monetization. In December 2020, we recorded revenue of $2.5 billion for $1.7 billion at the end of 2019, an increase of 40% year over year. We monetize our business primarily through advertising. Okay, so now you understand where she fits into the picture. She's the person who's responsible for trying to get this number up as much as possible. So, in other words, it's how much do you believe in this person to actually keep this trend going. I think she's gonna be the big person to look at in management. All right. I guess with that, since are there any other questions so far? If anyone wants me to talk about anything else, maybe like coding interviews or just other financial shit in general, feel free to holler. Otherwise, I guess I'll stop the stream. You know. Holy fuck. Yeah, this is probably the big one you want to look at. We measure our business using APRU. The rate at which they're monetizing their user base. Yeah. So in other words, when you work at Snapchat, you're basically betting on how well the company can squeeze an additional dollar from its user. That's I don't know. I don't know if I want to be involved in ad tech, to be honest. I'm not sure that's a great way to go. I mean, if you're doing infrastructure for this, maybe it's worth it. But like, holy shit. What courses would you recommend besides that website? Honestly, like I'm not gonna lie when I say this. I'm gonna say the Berkshire Hathaway newsletters. I think the way Warren Buffett writes the shareholder letters is actually phenomenal, especially the ones prior to 1990 to I would say prior to 2005. I think that it's written in a way that really is meant to educate you. So like if you go to berkshirehathaway.com and look at the letters, you can see here like I've read pretty much every single what's it called? Every single letter from 1977 to like fucking 2010. Like, and I have like solid hard printouts of them actually. Like, I'm not even fucking kidding when I say like print these out and read them. They're like 20 pages long, but they're super useful in learning how to read like 10Ks and knowing what to look for in a good business. And I think that it's super worth it. So actually, let me pull up one and I'll give you an example. I think the 1983 one about Goodwill is this the one about Goodwill? Yeah, 1983. So, if I look at this, and I go down to the end, right? To the, it's more to... Yeah, so if you look at this, he basically writes in a way, like, what the difference between accounting goodwill and economic goodwill is. It's a great learning experience. And I think if you read enough of these letters, you actually get a pretty good understanding of how to read these financial statements. And this one's completely free. So, the way I would read this is that you want to first understand the story of what's happening. Ignore the numbers for now. Understand what's happening in Berkshire Hathaway when they buy and sell businesses. And then after that, focus on the numbers. They'll point out some numbers like, hey, why does this number look funny? Just look for the numbers that look funny and then try to see if they explain it. And that's how you learn. But I would highly recommend if you're looking for a free alternative, this is absolutely fantastic. And they also, I think they also mentioned a few times of like, oh yeah, corporate fraud, like, you know, like some like corporate fraud is super interesting actually. I think Warren Buffett actually points out a few ways where people actually try to skirt around and abuse essentially gap principles. So let me actually find that one. I think it was the 1985 one. The unsell where he talks about like trying to sell unsellable companies. Fuck. God, was it the 1985 one? Or 87? I don't remember, but I remember like one of the lessons that he wrote was like he's trying to explain how people end up using like capital expenditures to hide improper reinvestment. So essentially remember how I said before there's like cash flow from operations and expenses that you incur? Essentially WorldCom, I think it was WorldCom, yeah. WorldCom did was essentially file the operating expenses under capital expenditures. So it made their operating cash flow look really good. And I think actually like in a 1980 or 1985 newsletter, Warren Buffett actually kind of talks about exactly the same thing. So if you're looking for some free ways of actually trying to read financial statements and learn about like what makes a good business or bad business, I think the Warren Buffett, Berkshire Hathaway newsletters are good. So, and I know there's like 30 years of knowledge here. Start from 1977 and start working your way up, man. That's all I'll say. Any other questions? Going once. Going twice. All right, man. I guess this is it for the stream. This is definitely different than what I usually do. So if you guys like finance streams like this and want to chat more about it, or you have any questions, or you want me to do this again in the future, let me know. Otherwise, yeah, I will stream again maybe next week or whenever R gets back the results of his Uber interview. So to recap, remember that he did his coaching session with me last week as well. And he currently has like a $250,000 offer from Google. And we broke down the numbers back then. So once we get back to his Uber numbers, hopefully he did very well, got an L4 offer from that, and then we'll chat with him about his whole experience going through the coaching interview and study with me. And hopefully we'll get some perspective. All his past coaching sessions are available to watch on my YouTube channel, so feel free to go ahead and do that. I'll organize them into a playlist at a later date, but you can go ahead and watch that yourself. I think there's a lot of value, especially if you're looking to go from a junior engineer to a mid-level engineer. And I think a lot of the lessons still apply even if you're looking for an internship. Other than that, I'll see you guys later, and thank you all for joining me.